Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Chewy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, $7 billion market cap. They're trading at $16 a share and they have 431 million shares outstanding. Chewy is an online retailer of pet foods and other pet-related products. It was founded under the name Mr. Chewy in 2011. In 2012, the company had revenue of $26 million. In 1 year, $26 million. They sure know how to scale. By 2017, a mind-blowing $2 billion, which was half the entire online US pet food market. Also in 2017, this company was purchased by PetSmart for $3.35 billion. At the time, it was the largest ever acquisition of an e-commerce business. Between 2017 and 2018, their revenue increased from $2.1 billion to $3.5 billion. Amazing growth story. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They always have positive free cash flow, a very, very small positive in 2021 and 2022. But then it grows from 9 million to 119 million, a 1,300% growth. It nearly triples once again into 2024 at 343 million. They did complete their 2024 fiscal year because their fiscal year ends January 31st. Their free cash flow per share went from below a penny in 2021 up to 80 cents in 2024. Each share is $16. So if you own one share, then you deserve that 80 cents. That's your cut of the business. Some companies give a dividend, some companies buy back stock, and companies like this mainly invest it back into the business to grow it. Net income is the profit or loss on the income statement. It's revenue minus expenses. A small negative in 21 and 22, a small positive in 23 and 24. They generate 9 cents of revenue per share, but they just finally broke even. You should expect this number to grow a lot over the next 2 to 3 years. Revenue is the sales for the company, and that grows every single year from 7 billion to 11 billion. They grew 25% in 2022, then 13%, then 10%. Not amazing growth, but it's a pretty big starting point, 7 billion, so it's hard to grow at really high levels. Their revenue per share is $26, so that means they generate more revenue than their market cap because each share is $16. So your piece of the revenue is $26. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 11 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $9.1 billion. We divide that by 431 million shares. And we get a calculated stock price of $21. They're trading at $16, so they're trading at a 24% discount. It's a pretty strong buy according to the model. So I may pick up some of this stock. It looks really tempting. And I love their business model because people always spend money on pets and kids. Sometimes they don't spend on themselves, but they always spend on their pets and their kids. That's guaranteed. There are 46 companies in the same industry as Chewy, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 143 million in CapEx. These are on the investments in property, plant, and equipment. Their debt-to-equity ratio is 1, so for every dollar of equity, they have $1 of debt. That is higher than the median average. They do not pay a dividend. They either buy back stock or reinvest their cash flows to grow the business. They are generating positive free cash flow, but it's pretty small. They rank 12th in market cap. Amazon is number 1 by far, probably bigger than the 19 other companies below it combined. They're trading at 14 times book value, 170 times earnings. Their price to free cash flow is pretty good. It's 20. They're trading at 20 times free cash flow, which is between the median and average. When I say 20 times free cash flow, that means their market cap is 20 times their free cash flow. But their revenue is unbelievable. They're trading at 0.6 times revenue. Their revenue is a lot higher than their market cap, which is not common. Because look at Amazon, they're trading at 3 times revenue, which means their market cap is 3 times their revenue. And Chewy's still growing quite a bit. Their 5-year annual revenue growth rate is 26%. Look at Pinduoduo, 79%. I guess they changed their name to PDD Holdings. Lots of big numbers on this list. 74% from C, 59% from Mercado Libre. This company is really big in the Latin American market. They're headquartered in Montevideo, Uruguay. I visited there once. It's a really nice city. If you put $10,000 into this company when they started trading, you would not be happy today. Down over 50%. Your $10,000 would be $4,700. At one point, your $10,000 would have been $32,000. So if you're bullish this stock, it seems like a really good time. They're trading at an all-time low. Let's take a look at Chewy's 10K. We'll start with their income statement. This shows us 21, 22, and 23. You can see sales go up about $1 billion a year, from $9 billion to $10 billion to $11 billion. Let's get a breakdown of the $11 billion so we know what it is. Of the $11 billion of revenue, $8 billion is consumables, and that increases about $1 billion a year, from $6 billion to $7 billion to $8 billion. Hard goods is actually down from $1.3 billion to $1.2 billion. And other is up from $1.6 billion to $1.9 billion. Hard goods are things like toys, beds, leashes. It looks like they're really trying to focus on selling the food, and hard goods are less focused. As long as their revenue is increasing, that's the main thing. Let's look at this income statement. It gives percentages. Below revenue is cost of goods sold. These are all the expenses directly tied to generating the revenue. This is mainly the cost to buy the products, because they have to buy the products and then they sell it to us. That was $8 billion. So their gross profit is going up every year from 2.4 to 2.8 to 3.2. Their margins are 28.4%. That means they converted 28.4% of their revenue into gross profit. It is going up each year from 26.6 to 28 to 28.4. It's important that revenue increases, but equally as important is margins. Because if their revenue was increasing, but their expenses were increasing faster, then their margins would be going down. But not this company. Selling, general, and administrative expenses, $2.4 billion, which is 22% of their revenue. That's increasing each year as a percent of revenue. Advertising and marketing, $742 million. That's going down. That was 6.9% of their revenue. Now it's 6.7%. It was lowest in 2022 at 6.4%. Total operating expenses, $3.2 billion. So they have a loss, an operating loss of $23 million. Last year, they had a gain of $56 million. Before that, a loss of $74 million. They receive $59 million of interest on their investments, and they have other income of $13 million. Taxes of $8 million, so they have a net profit of $40 million. Lower than last year, $50 million, but a lot better than 2 years ago, a loss of $75 million. They generated 9 cents per share, down from 12 cents. And their shares outstanding are increasing, 417 million to 422 million to 429 million. In order to scale and grow, you need money. So that's why they're issuing more shares. Hopefully, they'll start buying back shares once they become really profitable. Let's take a look at the balance sheet. Current assets of $2.1 billion, current liabilities of $2.1 billion. So their current ratio is 1. As long as it's 1, it's okay. It's actually slightly below 1, but that's fine. They have over $1.1 billion of cash and marketable securities. So they have a pretty good runway of cash. Accounts receivables, this is how much money other companies owe them when they sell on credit, $150 million. They're always going to have a lot of inventory on hand, over $700 million. Prepaid expenses of $97 million. This is when a company makes an advance payment for a product or service they're going to receive in the future. And they have $520 million of property, plant, and equipment. Here's a breakdown of that number. $170 million of furniture and fixtures. Computer equipment, $76 million. Internal use software, $180 million. Leasehold improvements, $312 million. Construction in progress, $80 million. So that's a gross value of $827 million. They depreciated $305 million. So their book value, the value on the balance sheet, is $520 million. They do some acquisitions, $39 million of goodwill. They talk about one of their acquisitions right here, Petabyte. In October 2022, the company merged with Petabyte. This company is a provider of cloud-based technology solutions to the vet sector, not veterans, veterinary sector. This acquisition is expected to further strengthen the company's pet healthcare product and service offerings. They paid $40 million for the acquisition. They gave the company $43 million, but part of the acquisition was $2.9 million of cash. So only $40.4 million of cash left Chewy. And you could see what Chewy received for the $40 million. The $3 million of cash, $1.5 million of intangible assets. This is the software they received from this company, and most of it was goodwill, $39 million. Goodwill is a plug. It's the premium you pay when you acquire another company. And that's actually all their goodwill. So this is their only acquisition they paid above book value. So total assets $3.2 billion, up from $2.5 billion. Liabilities $2.7 billion, up from $2.4 billion. They have $1.1 billion of accounts payable. This is how much money Chewy owes other companies when Chewy buys on credit. Accrued expense is $1 billion. An accrued expense is when a company has incurred an expense it hasn't paid yet. And they give a breakdown of the accrued expenses. Outbound fulfillment, $500 million. Advertising, $100 million. Payroll, $83 million. And other, $325 million. Assets minus liabilities equals equity, $510 million of equity. They received $2.5 billion from selling their business. They lost $2 billion from running their business. Let's take a look at the statement of cash flows. The first section is operating cash flow. Even though they only had $40 million of net income, they generated nearly $500 million of cash flow, mainly from these two items, depreciation and stock-based compensation. These are non-cash items that bring down your net income, but they do not affect cash flow. Then you have the investing section. They spent $143 million of CapEx. These are investments in property, plant, and equipment. That is lower than last year of $230 million. And it shows the acquisition last year. They spent $40 million on that acquisition. Only a few $100,000 this year. In their financing section, they had a cash inflow of $72 million. Mainly proceeds from their parent company PetSmart, $60 million. Let's take a look at the company on Simply Wall Street. Its last price, $7 billion market cap. It is up 4% in the past week, down a lot in the past year, down 57%. Let's see what they say about the company. Chewy is a pure play e-commerce business in the US. It provides pet food and treats, pet supplies, and pet medications. I buy my pet medications from this company and other pet health products, as well as pet services for dogs, cats, fish, birds, small pets, horses, and reptiles through its retail websites and mobile applications. They were founded in 2010, based in Plantation, Florida. They IPO'd in 2019 at $32. 9 months later, it was down about 20% to $24. That was in March 2020. 1 year later, March 2021, it hit 109, its highest ever. If you bought it north of 100, you're down a lot, over 80%. In mid-2022, it was $25. Then over the next few months, it doubled to $50. And then it kind of traded sideways for about 6 to 9 months. It was close to $40 in July 2023, but then it's dropped like a rock since then. Now it's trading below $20, its lowest levels. Its lowest ever was just a few weeks ago at $15.26. It's not much higher now. So if you like this stock, it's a great time to buy. I'm not sure if it's going to keep going down. I think there's a lot more upside than downside, but who knows when the bottom is. Simply Wall Street's valuation is 28. They say the stock is 42% undervalued. 24 analysts priced this stock at 24. That's the middle school I went to, IS 24. In Staten Island, New York. Their revenue forecast for 2025 is $11.7 billion, 2026 $12.3 billion, 2027 $13.3 billion. Free cash flow forecast for 2025 is $360 million, 2026 $409 million, 2027 $516 million. Look how much their revenue has grown over the years. It was $900 million in 2016. Imagine having a company with $900 million of revenue. That's a lot of revenue. And that's a low number for them. They grow every single year, from $1 billion to $2 billion to $3.5 billion to $4.5 billion, over $6 billion, 7, 8, 9, 10, 11. Now they're a little over 11. According to Simply Wall Street, they're debt-free. Simply Wall Street only looks at their long and short-term debt. Other companies consider lease liabilities debt. And you can see they had negative equity for a few years, but now they have positive equity. That's the blue line. And this green line is their cash. Look how much cash they have. Almost $1 billion of cash. A lot higher than our equity. The CEO's salary has been $1.2 million for a few years now. Total compensation $2.5 million. Tenure as CEO 6.1 years. Let's look at the insider trading activity. A couple of buys in the past year, one sell. 69% of this company is owned by private companies, 24% by institutions, and 6% by the general public. Their biggest shareholder is Argos Holdings. This is PetSmart. They own 69% of this company. The next biggest shareholder is Baillie Gifford, the Scottish investment firm. Then Vanguard, we all know Vanguard. The Connecticut investment firm Voya owns 1.5%, Morgan Stanley 1%, BNY Mellon, BlackRock, T. Rowe Price, the CEO, Geode, Citadel, Fidelity, Susquehanna. Their employee count was 10,000 in 2019. It peaked at 21,000 in 2022. It's down to 19,000 currently. And the ticker trades on the New York Stock Exchange, Deutsche Börse, and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.